You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. Well, you ever get your statement back from your broker, from your bank, and you look at the numbers and you say, what am I doing with this person? Why don't I fire them? Well, person you're about to hear from will explain to you exactly why you should be firing your broker, if there's any still around, and how he has accomplished a 3,600% return. His name is Dan Calandro. Dan, it's great to have you on the show. So, lose your broker. Can most people make money on Wall Street without a stockbroker, or can they lose less on their own? Put it that way.
I think the only way to make money on Wall Street is without a broker, to be honest with you. It's really not that hard, but there, is a strategy to it. And what I do in the book, Lose Your Broker, Not Your Money, is just to give the reader a plan, a strategy to outperform the portfolio their broker put together, or, any major market index that they want to beat, Dow, S&P 500, NASDAQ, whatever it is, with less risk. That's the method that I outline in the book.
Okay. So how do you do it? Is it that simple?
Yeah, anyone can do it, and you got to have some basic knowledge, which I lay out in the book. But what the book basically does in my method 1551, what it does is basically stack the odds in your favor, and 100 million Americans own on average 4 mutual funds, Kerry. 100 million. So basically 1 out of 3 people, right? The average mutual fund owns around 1,000 stocks. So they have a collection of, say, 4,000 stocks, and they're trying to beat a 30 stock index called the Dow Jones Industrial Average. And do you really need that much? And the answer to that is no. All you do is basically increase your risk and marginalize your return. My book basically centers around my method 1551, which is comprised of 15 stocks. And my method proves that you could be market diversified with 15 stocks. So if you can be market diversified with 15, why own 30, the Dow 30? Or why own 505? Because the S&P 500 actually has 505 stocks in it. And why would you own a collection of 4 mutual funds or 4,000 or 5,000 stocks to try to outperform a 30 stock average, right? So
you pick those 15.
The 15's easy if you know how to lay them out, right? If you know your blueprint of construction, which is a allocation model, and that's my 1551 model. It's covered in chapter 3. If you know how to be market diversified, you basically know what kinds of stocks you're looking for. And in the book, I take the reader on that journey. And the way I do it is say, okay, here's the definition of the market, right? Most people call it the S&P 500 or the Dow Jones Industrial Average. I call it the Dow Jones Industrial Average. And the reason for that is it's 30 stocks and I can understand it, right? So I start off by saying, okay, I'll take 15 of the Dow 30, and then I'll just improve it. And so what you end up with is a smaller group of stocks that are all above average. So it should be no surprise to anyone that this portfolio consistently produces above average returns, which it does. And again, 100 million people own on average 4 mutual funds. Their average amount of money in the market is $125,000, right? So what they do need is some powerful results, which you can only get with smaller numbers. I use the analogy all the time from the military. I got a lot of friends in the military, and United States of America wants to kill Osama bin Laden. They don't send a whole U.S. military after him, which is right down the street, right? He was right down the street from a very large Pakistani military complex. But they didn't send the whole military. They sent a Navy SEAL team or 2. right? Why? Because they're stronger, faster, and smarter. Same thing with my portfolio, my method.
All right. So picking out these 15. Right?
Yeah. And again, I'm a market diversified portfolio. So I look to spread my investments in a market diversified manner. Technology for me is not my number one industry. It's actually my number two industry. Consumer staples and consumer services, are my first picks. But again, it's a method, it's a process, and I lay it out, in my book. And the best way to find the best investments for you or for anybody is to go through your house, look at the goods that you buy, the services that you use, follow your money, and those are the best investments for you. That's how I do it. And basically the book is just the way I do it. I've been following the stock market since 1987 when I was in college. Black Monday was a big day for me.
I remember it.
And what's that? You remember it?
I remember it well. So
yeah,
kind of doing a walk down Main Street situation like Peter Lynch describes in his book, One Up on Wall Street. Like his thing was, it used to be you go to the mall, you see which stores have the crowds, you buy those stocks. Nobody uses the mall anymore, so I guess you have to find something else. So you're not in tech. What is the heaviest concentration of these 15 stocks that you're in now? Can you?
My number one stock, Kerry, is Church and Dwight. Do you know it?
I don't know. It sounds like a men's clothing store.
Yeah, I guarantee you, if I rattle off all 15 of my stocks, you'll know every single one of them. And for your audience that doesn't know who Church and Dwight is, I love this stock. I've loved it forever. Great management team, clearly. Arm & Hammer baking soda. You ever hear of that?
Yeah,
it's in everybody's house.
Occidental Petroleum.
They Church and Dwight is Arm & Hammer. And a bunch of other great product lines, and a very well managed company. They're my number one holding.
Oh, well, hey, this is, if you're looking for the birth control angle, they own Trojan, OxyClean. I use them. Waterpik, Zicam, TheraBreath.
Yeah. And again, how did I find them 25, 30 years ago when I bought it? How did I find them? Going through my cupboard. Think about Arm & Hammer. It's in every household. It's everywhere. Every restaurant, right? Every bakery.
Mm-hmm.
And again, that's a consumer staple. That's
got it.
People buy their products out of need more than want. But yeah, that's my number one in the consumer staple service.
Our industry sector. Deodorant. I didn't even know they were still around.
Yeah.
Give us another here. This is fun.
All right. So, you want me to change in the industry? What are you kind of looking for?
Number two in your history.
You want number two in my number one industry?
And are these buys for today, or are these just stocks that you bought?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
Though, these are in my portfolio, and in the book, I create a portfolio, and I take the reader on this journey so they can learn how to build a portfolio, right? Because that's what it's about. It's not about picking stocks. It's about building a portfolio that'll achieve your objective, right? And the objective for this portfolio, and if you go to my website, loseyourbroker.com, and you look at performance, the purpose of this portfolio is to do two things. Well, it's supposed to do one thing. It's supposed to indicate how the stock market strength is performing, okay? That's its objective. That's its purpose in life, this portfolio. And it's got to do two things. One, it's got to outperform the market averages, therefore producing above average or, quote, strong results, right? And it's got to move in a market-like manner to prove that it's market diversified, right? The Dow really, Dow theory basically pioneered market diversification because it proved, well, in the beginning, it did it with 12 stocks, but the world was different in 1896 when it was invented. But the Dow proves that you can achieve market diversification with 30 stocks. I prove, 1551 proves that you can optimize market diversification with 15 stocks. So why own 30, 500, or 4,000 if you can achieve the objective with 15 and earn higher returns with less risk? Because obviously 15 stocks has less risk than 4,000, right?
Right. Okay. So tell us another one.
Okay, so my second one on my list there is United Healthcare. And United Healthcare was added to this portfolio after Obamacare passed a Supreme Court hurdle to be quote unquote constitutional, even though a lot of us think that it wasn't. But once it passed the Supreme Court hurdle to make it legal, I know, just like we all know, anytime the government wants something, they inflate it. They pump a lot of money through it. And so I added United Healthcare because I figured the government would pump a lot of money through the healthcare sector. And inflation is good if you own stocks, right? Because it pushes the price up. And when I added United Healthcare to my portfolio, the 1551 indicator, it was $67. It's $488 today.
Not bad. Not bad. Okay, one more. Your top three.
Well, I'll give you a different. I'll give you my number one technology holding just because everyone knows it, and you don't have to love the company as much as you use it, right? And Google is it, right?
Yeah, not a real fan, but
yeah, with you. I'm with you. I agree with you. But geez, everybody uses it, including me, for a lot of different reasons. They're big, cash flow positive, big investor. They're taking over the world. You might as well own a piece of it. The easiest way, and I for the longest time, I had ExxonMobil in my portfolio. And the reason is because there's a lot of Exxons around my house, and I buy a lot of their gas, and I pay for their profits. I might as well own a piece of it, right? Get some money of my money back.
Right.
And for me and my method, the way I teach, the way I coach it, is to make it very personal, because investment's personal for you. Generally, you'll do the right thing by yourself because you're doing it for yourself, right? And my big thing with Exxon was they just weren't expanding to other forms of energy. They were just, it was all about oil always, So I shifted out of them and got one that was more integrated to other forms of energy, including gas, natural gas and solar and battery and hybrid kind of technology. So that's the way I invest. Make it personal to yourself. I owned Boeing for years and years and years. I sold it. I got rid of it with their debacle around the MAX, and it's still going on. They handled that about as poorly as you can handle it.
Sure.
The government handled that about as poorly as they could have handled it.
So tell us, Dan, who did you replace Exxon with?
The Southern Company, integrated energy,
right?
Vertically integrated energy.
Utility at one time?
Yeah.
Right. All right. How do you like FPL, which is...
I don't know them. I don't follow that.
Yeah, I'm in Florida, so I follow them every month because I get a bill. But so looking at...
Yeah, that's the way to do it.
Looking at utilities, and it's probably the best utility in the country. But looking at utilities here and the move to EVs, it's very similar, and you raised it, to Obamacare. Effectively, it's Obama energy.
Indeed.
Like, all right, your healthcare sucks. We're going to give you a new, better version, which isn't, but we're going to put 10 times more government dollars into it. Here, your ICE car is garbage. It's killing the children. We're going to put you into EVs, and we're going to make it irresistible for you to buy an EV. We'll even give you $7,500. So obviously the Teslas of the world, are going to compete on a business-to-business basis, and they'll either succeed or fail. Right now, Tesla is the huge winner from this velvet fist of the government, and I probably believe that it will be longer term as well, because they get the whole electrification thing. They've built a company around it. But downstream from there, who's going to be the biggest beneficiaries? It's going to be electric utilities. Has to be. Not so much from the standpoint of they're the biggest power producers, which they are, but they're going to be the intermediaries of people that produce alternative energy, and they're going to get their cut way more than they deserve, because the way in Florida it's set up, they're going to clean up on this thing, man.
Yeah.
They're going to get tons of subsidies. So the best electrical utilities out there, particularly in the Southeast, Southwest, where governments are less meddlesome and punitive, and they're recouping their investments and turning a profit, FPL has got to be number one. Plus, they're literally, their headquarters 4 miles down the road from me.
Yeah, exactly. And you know, you're right. I agree 100%. I mean, I'm not a big fan of energy. I mean, you know, I'm a CFO, financial analyst, whatever you want to call me, right? Energy is a completely different balance sheet. I mean, it's always given me problems to assess. The reason why I own an energy company, and I don't love energy as a whole, as an investment, because I can't understand it, right? The financials as much as I'd like to. It's because it's in the market. It's a big piece of the market, and I want to be a market diversified portfolio. So, you know, that's the reason why I'm there. But I make very personal decisions in management of my portfolio. I sold Nike when they embraced the Colin Kaepernick kneeling at the flag thing. I just thought, you know, why would you want to turn off? Why would you want to turn off half of your, half of your customers in the biggest market in the world, America? I thought that was a bad move. But Boeing with the way they handled the Max, it scared the heck out of me. I mean, as an investor, I sold that. I got into Lockheed Martin because I needed that market allocation. So like I said, my 1551 method gives you that blueprint.
Got it.
Of the market segments that you need to cover to be market diversified. So I know when I pull something out, I need to replace it in this market. Or when the Dow changes, the Dow goes through its changes just like every other portfolio. Yeah. And when the Dow changes, they change the definition of what the quote unquote market is. So I make my adjustments based on it,
Got it. All right. So, all right. Again, tell us the book, and I assume it's available wherever fine books used to be sold, Dan?
It's available on my website, loseyourbroker.com. It's Lose Your Broker, Not Your Money. Check it out. It's easy to read, simple to do. It works. And, I'm there to coach and support. So it's pretty much got everything you would need to take investment, buy the reins for yourself, and start outperforming, because the Wall Street model is broken and it doesn't work, and it's made for them, not you.
Who would ever think that? All right. Hey, got a question for Dan? Shoot me an email, kl@kerrylutz.com. Make sure you go to the site. You'll find the link to Dan's site there, financialsurvivalnetwork.com. It's right in the show notes. And while you're there, sign up for your free newsletter. Dan, a pleasure. We will definitely have you back on, and appreciate you coming on.
Anytime, Kerry. Thanks. Take care.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.